Morning. Thanks so much for joining the Finance and Housing Committee meeting of the Seattle City Council. Today is Wednesday, May 17th, 2023, and the time is 9:33 a.m. The meeting will come to order. I'm Teresa Mosqueda, Chair of the committee. Will the clerk please call the roll?
Councilmember Herbold.
Here.
Councilmember Peterson.
Here.
Councilmember Nelson. Councilmember Lewis. Madam Chair Mosqueda.
Present.
Madam Chair, that is 3 present, 2 absent.
Okay, thanks. And we will make sure to note the other council members when they join. I believe Councilmember Lewis is going to be joining us momentarily. Colleagues, we do have a full agenda today. Thank you for joining us both virtually and in person to continue to help reduce any communicable diseases, including the flu, which happens to be at very high rates this year and claiming more lives than usual, and ongoing cases of the COVID-19 virus, though we are very thankful that the rates of infection and hospitalizations continue to go down. And good morning, Councilmember Lewis. We noted that you would be joining us soon, so Councilmember Lewis is present. We will continue to operate these meetings in a hybrid fashion, encouraging people to dial in remotely or to provide public comment in person. You still are welcome to do that. And in our meetings, we always want to make sure to encourage folks to participate online, especially if they don't feel well. In today's Finance and Housing Committee, we have an update on the General Fund Financial Plan, an update on the Office of the Economic and Revenue Forecast Projections, and the City Budgets Office, both of which have a responsibility for overseeing different streams of revenue. So this will be our opportunity to do the revenue forecast report out. We always have these meetings following our quarterly Office of Economic and Revenue Forecast projections. And today is the first opportunity that we've had to hear a report back on the April forecast. And then the last 2 items that we will have is a discussion and possible vote. My hope is that we will be able to vote on the carry forward and the exceptions bill. If there's no objection, today's agenda will be adopted. Hearing no objection, today's agenda is adopted. And colleagues, I did just want to note for the record before we go into public comment, I will be asking to take the Office of Economic and Revenue Forecast and City Budget Office item first. I believe that's listed as agenda item number 2. We will then go back to agenda item number 1, which is the General Fund Financial Plan and the Central Staff Report out from Tom Mikesell. Hearing no objection to that amendment, we will go ahead and have Director Ben Noble and our team from City Budget's office up at the beginning. Okay, we do have at least 1 person signed up for public comment. On today's public comment, we will happily hear from anybody who dials in. Again, you have 2 minutes to provide your public comment, and you will hear a chime when there is when your time is running out. That's your indication to wrap it up. At this point, I see Katie Wilson on the line. Good morning, Katie. Thanks for joining us this morning. And do we have Katie?
Oh, yes. Hey, can
hi,
you hear
Katie.
me?
Good morning.
Hi, good morning. Hello, council members. Katie Wilson here speaking on behalf of the Transit Riders Union. We are very concerned about the City Budget Office's direction to departments to hold back $14 million in Jumpstart spending this year. We understood that the city's commitment was to maintain the $220 million baseline of investments that were estimated to be available in 2023 when the tax was passed back in 2020. We understand that revenues from Jumpstart are still coming in over these budgeted expenditures, so we don't think there's any good reason to deprive vital programs of the funding that they've been counting on. Requiring departments to make these cuts will have a direct and negative impact on the communities that the City of Seattle committed to serving with these funds. These cuts would reduce affordable housing development, reduce small business support and workforce development efforts. They'll reduce funding for community-based organizations that are building capacity, acquiring land, and doing major capital projects. And they'll delay or derail projects to establish climate resilience hubs, Indigenous-led sustainability programs, and convert homes to electric heat. In just a few months, the August revenue forecast will give the city a much fuller revenue picture. So we urgently ask you to remove the holds on funding for all of the departments funded by Jumpstart revenues and work with the community after the August revenue forecast is known to collectively address any near-term revenue gaps. Thank you.
Thank you very much, Katie. And I don't see anybody signed up for public comment in person. Is there anybody else who is interested in providing public comment on the line that we might not have let in yet? All right. Well, thank you so much. And if you do have additional public comments that you'd like to provide, you can always send those to council@seattle.gov. And I believe we will. Oops, sorry. I'm just getting a message from someone that they're trying to dial in and not able to. So if there's any concern with our public comment options, and people want to continue to dial in, let's leave that screen open for a little bit in case there's been a glitch of some sort. All right, with that, we're going to go ahead and move on. Oh, I do see Jesse Simpson. And Katie Garrow. We'll just give it 1 minute here. Okay. We can come back to anybody who wants to provide public comment. Maybe we'll move on to agenda item number 2. Madam Clerk, could you please read agenda item number 2 into the record?
Agenda item number 2, Office of Economic and Revenue Forecast and City Budget Office for an economic and revenue forecast update for briefing and discussion.
Thank you so much. And I want to welcome the team from the City Budget's Office and Director Ben Noble and anybody else from your team at the Office of Economic and Revenue Forecast. Thank you for the work that you do. Every quarter, we hear from the Office of Economic and Revenue Forecast on the revenue projections that come in. And we have a chance to hear from folks in the subsequent Finance and Housing Committee meetings. In last month's Finance and Housing Committee meetings, we have actually put those on hold to have a chance to get into the housing levy, which all of our council members participate in. So this is the first chance that we've had to hear from our Office of Economic and Revenue Forecast on the April forecast. And it's also the first chance that we have to hear from the City Budget's Office on any additional revenue streams that are under their purview to provide a fuller picture of the revenue forecast. Director Noble, before I turn it over to you, I do see one more person that signed up for public comment, so I'll allow them to go for their 2 minutes. And Jesse, thanks for dialing in. Sorry for any technical issues that we're having on our end. Please go ahead. You have 2 minutes.
Hi, Councilmember Teresa Mosqueda. Thanks for the opportunity to testify here today. I'm Jesse Simpson, Government Relations and Policy Manager for the Housing Development Consortium. Just about to send in a letter to Council and the Mayor's team about our concerns regarding the Jumpstart spending plan for 2023, well, specifically the $14 million hold that we hear departments have been $14 million holdback in spending that department's been directed. We think that this violates some of the agreements in the fall budget process to allow Jumpstart to temporarily fill a gap in the 2023-2024 general fund. We think that we need to retain the commitments to the original Jumpstart spend plan, maintain the $220 million baseline Jumpstart investments that were estimated to be available in 2023 when the tax was originally passed, and to replenish Jumpstart equity investment priorities if the general fund revenues are higher than assumed in the adopted budget. With this April revenue forecast showing 2023 general fund coming in $74 million higher than anticipated, we see no reason to direct departments to underspend budgeted Jumpstart revenues in 2023, reflecting a anticipated reduction in Jumpstart revenue itself, especially when the fuller revenue picture will be known in August, just a few months. These holds have a direct impact on the communities that the City of Seattle has committed to serving with equity and focused investments in the Jumpstart spend plan, and it will have tangible negative effects on our community. I urge you to remove the holds on funding. Thanks for working with us.
Thank you very much, Jesse. And we will keep an eye out for that letter you mentioned. With that, we will go ahead and move it on over to our Economic and Revenue Forecast Director Ben Noble. And of course, the team from City Budget Office is on the line here with us as well. We'll turn it over to you for any additional context to round out the April revenue forecast projections. Good morning, Director Noble.
Good morning, Chair Mosqueda, and thank you for the introduction. I'm going to dive right into this. I am joined by Jan Duras and Sean Thompson from the Office of Economic and Revenue Forecast, and by Dave Hennis and Alex Zhang from the Budget Office. And I'll lead the presentation, turning it over to the Budget Office for a couple of particular areas of their specialization, and then may call upon others in terms of addressing questions. Next slide. So this presentation is largely a shortened version of the one that we provided to the Economic and Revenue Forecast Council, which again, if you recall, includes representatives from both the legislative and executive branches. We presented this April forecast update in April, and we're delivering it to you now. One of the things I wanted to highlight is that the economic conditions that underlie our forecast update are essentially from the middle of March, because we process them for a couple of weeks and then deliver the forecast at the beginning of April. We're now into the middle of May or so. So there's been some time since we made the initial presentation. Much of what I'm going to present is unchanged, and I'm intending to present it so you have the context that was then present when we developed the April forecast. That said, I will come back at the end and make a few comments about what's transpired since we developed the forecast. Just in terms of kind of broader context, recall that the last forecast before April was one that we delivered in November to the City Council as you were deliberating and taking final budget actions. And it was based on information through essentially the middle of October. So we're basically 5 months on by the time we did the April forecast. So there was a significant amount of time has passed. So as highlighted here on this page, we're going to start giving kind of just a general economic update, what had transpired since November, as kind of feeding the April forecast. Then we'll look at both, just one slide each. The national forecast, we use a national forecast to develop our regional forecast. So the national forecast projects jobs, employment, income, inflation, and the like out for several years. We feed that into a regional model that does the same. And then we use that regional model for the revenue forecasting itself. So we'll talk about the national model, the regional model, then we'll dive in to talk about the revenue forecasts themselves. First, the general fund, and then some key non-general fund revenue sources, in particular, Jumpstart and REIT, both of which are significant revenue streams, and as you'll see, are significant components of the forecast update. And then, as I mentioned at the end, come back and just give you a couple highlights on what's happened really since April, because I think there's some pieces there that are relevant. Next slide. And one more. So basically, as we were developing the April forecast, relative to November, things were and are better in the sense that we had the forecast that underlied the November estimates had assumed that we'd fall into a slight and a minor recession in the first 2 quarters of this year, 2023, and that we'd finish somewhat weakly in 2022. And that didn't happen. The fourth quarter, late third quarter and the fourth quarter were quite strong, both nationally and regionally. So at a national level, we're adding 300,000 jobs a month. Inflation had been running, as high as 9% locally in June. Even nationally, 9%. It had fallen to 7.5% in November, but since then it's continued to fall. In February, it was down to 6.0%, and then fell again in the most recent announcements. So we were getting stronger job growth, and inflation was still high but coming down. So again, things were generally good. There were some significant risks that were apparent in the April timeframe. The Silicon Valley Bank and Signature Bank had just failed, and in general, sense that was going to tighten lending markets. So it was going to be harder to borrow money, which was going to have the effect of slowing the economy overall. And we'll talk some more about that. And in fact, we had seen that starting to happen. And we'll show you some data to give you a sense of what's happening in the local real estate markets, but similar patterns nationally. And then in terms of risk, one of the things that the strong jobs are both good news and bad news. Good news because employment growth is always good. Bad news because it's going to increase pressure on inflation, which in turn is going to lead the Fed to crank up interest rates. And again, they've taken that action actually since since the April forecast. So there's some concern that the strong job growth is going to lead to ever more pressure on interest rates. And then the last risk that was we identified in April and is now only ever more present is the debt ceiling, and the concerns about whether there will be an agreement on that and what the outcomes might be if there's not. So overall, things were better than we had been forecasting, and you'll see that in the numbers. So revenue forecasts for many of the revenue streams are up because we did better at the end of last year and are expecting to do somewhat better in near term, but there are risks out there. Next slide. So this slide highlights that a lot of what we're seeing in the economy is being driven at present by the Federal Reserve Bank and the actions that they are taking to try to cool the economy. So on the left, you have a chart that shows in orange the federal funds rate, so the interest rate that the Fed charges to banks. This is the interest rate you hear about them changing. You see the 30-year mortgage rate, so that's if you're going to buy a house, that's the interest rate you would pay. It's also just a general sense of kind of what it costs to borrow, whether you're in private business or trying to buy a home. And then the last line, the gray line, is inflation. And we tend to think of that the orange line is causal here and is driving change. So in middle of last year, the Fed started to raise interest rates because it was concerned about the top line, about the gray, about inflation, that it had been increasing and then starting to increase more sharply. So they if you will, declared war on inflation, started to raise interest rates at the federal bank level. That had the intended effect of raising interest rates in private markets, so the mortgage rates started to go up, and that had the entire desired effect of starting to bring down inflation. Higher interest rates means that it's harder to buy things that require borrowing money, so less capital investment that has the effect of cooling the economy, cooling the amount of demand, which in turn ideally brings down inflation. So this is working if you're from the Fed's perspective, perhaps not as directly and as quickly as they had hoped. But inflation is coming down. The economy has cooled some. And the chart on the right was highlighting some of that notion that the economy more broadly is cooling. So this is monthly job creation in thousands through March. And I've drawn that line and put sort of a question mark on it because through the end of last year, you could see sort of a trend that the job market was cooling. There were obviously some spikes in January and February. Some of that data has actually since been corrected. In general, the labor market is very strong, but has been cooling somewhat. So that again, the Fed is having some of the effect that it was hoping to, and we'll see that again as we go forward. Next slide. One of the elements we did want to highlight, however, as strong as things are, that there are particular risks to our regional economy, and they have a lot to do with the tech sector. So last fall, we were seeing the early signs of slowdown in the tech sector. That has really, over the past 5-6 months, really become all the more apparent. And the chart on the left here highlights why that is a particular concern for us in the Northwest region. So this compares the U.S., Washington State, and Seattle. It's taking the beginning of January 13 as an index, or starting there, measuring in percentage terms how much has employment in the tech sector grown, essentially in the 11 years since January 2013. On the US level, the blue line, it's grown about 25%, healthy, but not remarkable. State of Washington, it's grown by more than 50% over that time period. And you can see in the green line for Seattle, it's essentially 60%. And we're really the reason the state has had its growth, right? You can see that we were pulling the state with us just in terms of the shapes of the graph and the rate of growth. So our economy has had a 60% growth in that one sector over that time. So a slowdown in that sector would not surprisingly have negative impacts here. An example of what that could look like on the right is office vacancy rates. On the blue line is the US. Again, this starts with the pandemic. So the national level vacancy rates were about 10%, and they've gone up above 12% over the following 3 years. But in Seattle, office market was very tight pre-pandemic. So we had vacancy rates below 5%. That's why people were building office buildings. Now vacancy is in excess of 13%, 14%, and going up as leases expire and people don't renew them. So, and that has, I mean, as we'll see, work from home has an impact on revenues directly, but also we're not going to see construction in the office and commercial sector anytime soon in all likelihood, because again, as per the graph on the right, we just don't have that demand. So our economy is particularly susceptible to the tech slowdown that we have begun, has really, taken hold in the past few months. Next slide. Wanted just highlighting that some more, talk about employment growth within the region and just how unequal it's been. So this is a chart that shows employment growth since June of last year. And this one we've actually updated since we did the April forecast, just because we had some more current numbers, and it's basically the same pattern. So you can see we've had significant job growth, 3+% just since June of last year, growing in most sectors. But what's interesting is not all sectors and also which sectors. So leisure and hospitality, largest absolute number of jobs. Again, that sector continues to be in strong recovery. We had a good tourist summer last summer, and by all accounts, bookings are strong for the coming summer. So people are staffing up there. But immediately below, you can see the tech slowdown very directly, a loss of jobs in that sector. Another place you can see it indirectly is in the professional and business services. That's 6,000 jobs. It's about the fourth bar down. That's still growth, but that's the sector. That's another place where the technology firms end up getting listed in these categories. And that's one that had been leading employment growth, and it is no longer. So we're seeing that the very uneven effects here, and in particular, the slowdown in tech is pretty clear here. You also see slowdown in the financial activities sector, again, likely related to higher interest rates. People not taking out mortgages and the like, meaning less work in that industry. So just give you a sense of that. Next slide. We're going to shift now to talk about the forecasts and the change in forecasts. So next slide. The first shows the national forecast. And again, these are the forecasts that underlie our regional model. Ultimately, based on the concurrence of the Forecast and Revenue Council, we're using the baseline forecasts, but the pessimistic gives you some sense and gives you some context for what's going on. So the previous baseline, so the two baseline forecasts are essentially pink or whatever color that is. And the previous baseline, that's what we had based our forecast on in November, had assumed an actual recession in the first part of 2023. And this is employment. So we were going to see a significant employment drop through 2023 and then growth afterward. The new baseline is one that, again, it's informed by the fact that the fourth quarter of last year was quite strong and employment continued to grow beyond what had been forecast. So the expectation now is really of the soft landing that had been desired. This is, again, the forecast anyway, as of April. So there was going to be some modest decline in employment, some sectors losing, some sectors gaining. That was going to plateau out pretty quickly. So on net, we were going to see almost no job growth over the next few years. So it's really a slow and steady position rather than a drop and then a following increase. But as you see, that meant that it was going to be better near term, but slower growth affecting the longer term forecasts in a negative way. And then just for context, there is concern about a pessimistic scenario, largely driven by events, the Russian war on Ukraine. If it continued to escalate, you would get increasing interest rates increasing prices and inflation leading to increased interest rates and a more dramatic cooling of the economy. So, but the bottom line is that the new forecast was for a slow growth scenario where employment would be steady, but not necessarily declining in significant ways. Next slide. We then translate that with our regional model into a regional forecast, and the general shapes here are comparable. Again, for us, employment is somewhat stronger, but still not showing significant growth. So you can see employment essentially flat lines for the next few years. Again, as one of the key drivers, tech slows down and others compensate, but not enough to drive a great deal of growth. And again, we also ran a pessimistic scenario, which again, consistent with the idea of higher inflation being driven by outside forces, leading to an overall cooling. So these were the generalized economic forecasts that underlie. And again, what they showed is that things were generally better near term, but in the longer term, expecting slower growth as this period of higher inflation lasts longer, because that's again what we're seeing is that inflation is more persistent than had been hoped and thought last November. That will lead for a period for interest rates to be somewhat higher for longer. And again, not so much a dramatic cooling, but a slow period of growth. So what does this look like on the revenue side? That's where we shift next. So next slide is a shift to the revenues. And first up is the general fund. And I see there's a question, maybe before we go on.
Oh, thank you. Please go ahead, Councilmember Herbold.
Thank you. Just a quick question. You note that there's an assigned 25% probability to a pessimistic forecast. Is there a probability for the baseline forecast?
I believe the baseline is at 50 or 55%. I don't have my notes in front of me.
Thank you.
So moving on to revenues, the next slide is full of numbers, so I'll take some time. So let me take time to set the stage for this. This is really the meat of the general fund revenue forecast. And you'll note there's bottom line, there's some good news here. I do want to highlight that there is more to come that will balance this sum. So just in terms of how to read this slew of numbers, the first column of numbers is the 2022 actuals. So that's how we finished last year. Really provided as a point of reference and potentially useful one. The next is the revenue forecast that underlies the adopted budget. So that's that first column of, that's the first column under 2023. The second column under 2023 is the April forecast. So that's the change. So those are the new numbers, and then the third column under 2023 is the change. So let me, one more time, the adopted budget, the new forecast, and then the change implied by that forecast. And then since it's a biennial budget, we're doing the same in the next set of columns for 2024. So the budget for the original budget, which is largely from the November forecast, the April forecast update, and then the change. And then in the last column, we've added the two changes. So you can see the change over the 2 years. And what I tend to do here is just kind of move down the column of revenue sources, highlighting particularly for 2023 what the changes are, and then they largely carry forward to 2024. So starting at the top, just the items that are sort of shaded in darker blue here are ones that the Revenue Forecast Office is most directly responsible for. I'll talk about those. I can talk about some of the others, and I'll turn it over to Dave and or Alex to talk about a few of them. So on property tax, we've changed the forecast slightly. In general, property tax is extremely easy to predict. We know in advance what it will be because of the rules about how revenue can only increase by 1%. What's driving a change here is actually the emergency medic 1 levy. The revenues for that are distributed to the city and the rest of the county based on our share of assessed value of the county. So bottom line, our assessed value didn't go up as much as the rest of the county or in relative to our forecast. So a little less revenue there because property values in the city didn't quite grow as fast as we thought they would. Effect is relatively small. It's the same reason for the change in 2024. Retail sales, again, we finished overall economy is somewhat better. So the baseline for 2023, so we finished 22 stronger. The baseline for 2023 is up some, inflation up a little bit as well. So that leads to a higher revenue forecast for 2023 on that side. Comparable for business and occupation tax, we finished the year stronger than we had anticipated last year. And then in addition, again, somewhat higher inflation leads to higher nominal revenues. And then also some change in the shifting here of folks who pay annually. So additional revenues accumulating in 23 versus 22. Private utilities up a little bit. That just has to do with the timing of when payments occurred. Public utilities largely unchanged. Dave, you might want to comment about parking meters and court fines, which are down slightly.
So parking meters are down largely because paid occupancy is down. And the question is, why is that? And we don't have a complete answer, but it's down about 6.6%. And so we're taking those actuals that occurred from 2022, looking at the data and assuming a decrease then in 23 and 24. Court fines, is an interesting story, but it is also down largely based on actual performance in 2022 being lower than expected. And there's a variety of reasons for that. One being, I mean, this is a combination of number of citations written and the payment compliance on the part of the public. Both of those are down a bit more than what we had originally forecasted. Another issue there is the beginning of collections, of referring citations that have not been paid to collections. That has started up again, but it started up a bit later than was assumed in the original forecast, which leads to a fairly large decrease there.
Then shifting down, another place was obviously significant increases in grants, almost $28 million of additional grant revenue. This is largely to do with a timing effect. So there were grants that we had anticipated receiving revenues for in 2022 that are now forecast to actually be paid off in 2023. The way the grants work is the city receives the money usually after the fact, after the work is done. So this was just a shifting in time of when we were going to receive the revenues. And I'll get back to that in just a second, just to highlight when we highlight the totals. The other kind of big increase here was in licenses and permits, and that was largely a function of, again, a timing one. So business license revenues, so folks can renew their business licenses either late the previous year or early this year. And what happened is more folks renewed early this year than they did last year. So we lost some revenues relative to what we expected in 2022, but they are now going to arrive in 2023. So that net effect was small. We get into the bottom here. We've done two totals. One is the total of all that you see, all of those differences, and it's almost $75 million positive increment. However, a big piece of that was these grants, and those grant revenues really are not generally available to be spent on general city needs. So we did a total as well that takes out the grants. So you can really kind of see what's available revenues, if you will. And that's still in excess of 46.6 million for 2023. For 2024, I'm not going to walk down the whole column again. It's largely the same pattern, because largely what you see is exactly that. The forecast was one for growth. We're getting really very modest growth into 2024. So we're not seeing big changes. And in fact, overall revenues, if you look, actually decline. So revenue forecast for 2023 in April is 1.7 billion, and for 2024 it's actually 1.66, so slightly less revenue overall. Again, that's largely to do with the fund balance transfers and grants, but still gives you a sense that we're not getting a great deal of growth. The increment for approximately 25 million for 2024. So over the 2 years of the biennium, a net increase of total revenues of just over 100. If you take out the grants, more like 70. So, and again, some of this is revenue that was really shifted out of 2022. When you get to overall, we're really just telling you the revenue story here. When you see the overall fund balance picture in subsequent briefings, you'll get a better sense of the overall budget implications. But again, this is consistent with what we were describing. We finished better than we were, than we thought we were going to finish in 2022. The first part of 23 has been strong. What you'll see that next couple slides is that the growth in the longer term, though, has also been affected. So if there aren't questions here, I was going to move to the next slide, which does talk a little bit more about long term. So this is a point that we probably could have made in November, but wanted to at least emphasize here with the April forecast. And that has to do with the longer term growth and the effect of the city operating in an environment where inflation is high and growth is relatively slow. A number of our revenue streams, property tax being the most obvious example, don't keep up with inflation. Property tax only grows by 1%, plus new construction, which at most means 2%. And in an higher inflationary environment, that means our overall growth in revenues aren't going to keep pace. So what we've done here is create a way to try to make that comparison. So define a baseline of core revenues. So what we did here, we took out, seeing that list of revenues on the previous slide, we took out grants, transfers, and there were some late payments from the payroll expense tax that end up in the general fund. So we took out things that are really one time, which you can't count on in terms of paying for general city revenues. sort of establish that as the core of our general fund. And then establish that as a baseline. So the green, kind of light green lines are taking the 2022 actuals of that kind of core revenues and growing them with predicted inflation. So that's how much we expect. If we were to keep pace with inflation, we need our revenues to grow equivalent to that kind of light green. The blue is what we expect revenues to grow at based on our revenue forecast and which in turn relies on our regional economic forecast. And again, what we're expecting is relatively slower growth. So what you see is an environment where for the next few years, we don't expect that core general fund revenues will grow at the same pace, as inflation. So the spending power of the city's revenues will be falling behind. That's an unusual situation for us. The last 10 years plus pre-pandemic, we were getting strong growth and our revenues were keeping ahead of inflation. So partly because inflation was so low. So this is going to be an environment that's going to be trickier to operate and budget in. But I just wanted to highlight that's one of the longer term implications of this new forecast. And again, you'll hear about this more in the subsequent briefings. So next slide, we're going to shift to the non-general fund resources. We have kind of the format of the table is the same in terms of the columns in tracking the differences between the April and the endorsed November, the adopted November forecast. The blue highlights the revenue streams that are responsibility of the forecast office. And we've divided them into two categories: of general government revenues. So these can be used for generalized government purposes, some of which are being determined by policy. The other ones are transportation revenues. Some of those are constrained by state law and other by city code. So starting at the top here, payroll tax. Just as a reminder, ultimately for 2021, some of the payments were made late, but in terms of the tax obligations, so people were obligated to pay tax of more than 290 million in 2021. That fell significantly, and we'll talk about this in just a minute, to 250 million in 2022. That in November, we didn't have the year-end results. So we really didn't know what was going to happen there. So we actually didn't update the forecast for November. We now have done that, and consistent with revenues falling back to 253 million for 2022, we're forecasting a modest growth to 263 million in 2023. But that represents a very significant decline relative to the forecast for November, and that was the basis for the budget. And again, I see a question this time from Councilmember Lewis.
Councilmember Lewis?
Hold that question for now, Director Noble. It's about something else. I just wanted to get in the queue when you're done on this slide. Thank you.
Sounds good. Sounds good. So very significant reduction. Again, it's driven almost exclusively by the actuals for 2022, and we'll talk more about this in just a moment. Comparable effect for 2024. So again, we're expecting relatively modest growth. So you get a similar adjustment in the forecast. So decline of almost 60 million, more than 60 million, almost 63 million over the 2 years in the payroll expense tax forecast. Admissions tax forecast is down only slightly, and actually it's better news than is apparent here for the general fund. The way the admissions tax works is a bunch of those revenues are essentially retained at climate pledge. But with this increase, there's actually a relatively higher share that are going back to the city coffers and in particular to arts and culture. Modest increases for sweetened beverage and short-term rental tax, significant decline in REIT. And again, we have a whole slide on this and we'll get back to this. But the interest rates are having a dramatic effect on the volume of real estate activity. And this is a tax that only is paid on real estate transactions. So it's obviously very sensitive to those changing dynamics. In terms of transportation specific revenues, really modest changes overall. Somewhat notable increase in commercial parking tax, consistent with increased activity overall. And then school zone enforcement down somewhat. Dave, you might want to comment there just because it's been a point of interest.
Sure. So the biggest issue there is that the city installed some new cameras and the anticipation about the volume of citations generated by those cameras was not as high as it had been in previous new installation situations. And so we're just making an adjustment for that primarily.
So again, overall, combined on the sort of that last column, you can see significant declines in payroll tax, significant declines in REIT, and then modest increases in other revenue sources. The next two slides are, one deals with payroll tax and another with REIT. So I don't know if Councilmember Lewis, you want to ask your question now or?
Yeah, let's do that.
My question is going to be regarding the commercial parking tax, so I'll just wait until it gets down there.
Actually, this would be a perfect time for that.
Okay. I just wanted to ask what you attribute the fairly significant difference of 3.3 million to in terms of the different forecast on commercial parking tax. To a certain extent, I've been led to believe can be a little bit of a proxy for downtown recovery and return to work, or just people going downtown, since that's where a lot of our commercial garages are. And I'm just curious if that is factoring into how we are forecasting the recovery and what the tea leaves of that difference might indicate.
Yeah, we definitely look at the commercial parking tax as sort of a leading indicator, if you will, of downtown activity. The big cause of this, however, is really, as Ben described earlier in the economic and movement of expected recessions, there we had built in an assumption about a recession, mild, even though it was, into the commercial parking tax forecast. And this essentially removes a lot of the negativity of that recession forecast, potentially spreading it a little deeper into 2023, but largely removing it. So that's largely the cause.
Great, thank you for that. And just one more question to clarify. Can the director or maybe Dave remind us what the applicable uses for commercial parking tax are? I know it's a general fund, adjacent, non-general fund source that is somewhat restricted, but could you remind the committee?
Sure. So it's restricted by state law to be used for transportation purposes. And there's a list of things that go into what transportation purposes include, but it can be broadly used, road repair, pothole filling, capital, et cetera. But it is restricted to transportation purposes.
Great, thank you.
SDOT has used considerable share of it to back up debt. So a lot of it is used for debt service on transportation projects. But again, transportation uses are eligible and you can use it to pay debt for them as well.
This might be a question for central staff. So if so, we can tee it up for the conversation to come. But given the ebb and flow of some of the revenue streams, general fund being up, Jumpstart being down, the various other streams a little bit up and a little bit down. My understanding was that across the biennium, we were looking at an $8.8 million reduction on the whole. Is that correct?
Good morning, Chair Mosqueda, Ali Panucci of your Council Central Staff. Yes, that is correct. And the reason why Central Staff sort of provided that summary number is it's somewhat nuanced because, as Director Noble and Dave described, not all of these revenue sources can be used for the same purposes. But in general, because we have a 2-year plan for 23 and 2024, what we were looking at is overall across the plan, what is the impact, and are there strategies to sort of hold true to the commitments in the 23 adopted and 2024 endorsed budget by sort of shifting certain expenditures around. And that will be a topic for further discussion when you get the mid-year supplemental budget in June, as well as the year-end supplemental budget in September, alongside the mayor's proposed adjustments to the 2024 endorsed budget.
Okay, great. We can have a conversation about that in a little bit. And while I have the mic, I want to say thank you to Councilmember Nelson, who joined us a while back. Thanks for being here, Councilmember Nelson. We have a full committee today. Okay, any additional questions on this slide while we're here before we get into some of the more detailed overviews? Okay, and if you can believe it, this is a truncated version of about a 2.5 hour presentation that we had in the Revenue Forecast Committee. So thank you for the summary here. Obviously, this is complex, and appreciate the chance to have presentation in the revenue forecast committee meetings, but also to make sure that we are reporting it out in this council forum and to the general public as well. And as a reminder, all of the economic and revenue forecast council meetings are also publicized and available on Seattle channel. So I'll turn it back over to Director Noble to help summarize the summary.
Thank you. Yeah, and I'll continue to move here. So next slide or two deal with the jumpstart. So obviously a very significant change in the reduction in the jumpstart forecast. So did want to take some time to explain that. So again, just highlighting on first bullet something that I mentioned, that revenue obligations fell from 293 to 253 between 21 and 22. It's a very significant decline, and we hadn't expected that. We got nervous about it towards the year end, and I'll talk about why. But the revenue forecast for 2023 had been 294 million, but given that we took in 253 for 2022, that was not a viable forecast. And we've updated it to approximately 263, so bringing it down about 30 million. How did such a big change happen sort of so quickly? One thing to recognize that makes this revenue source different really from every other in the city, certainly of this scale, is that it comes from relatively few firms. And those firms are themselves concentrated in a single sector, tech. These firms record their activities in different places. So Amazon is an example of a tech company. It's actually engaged in a lot of trade. So sometimes you'll see when we divide it up into different sectors, but at the end of the day, that's what I'm talking about, those large firms and firms like that. One of the things we figured out in trying to understand what happened between 21 and 2022 was that there are two potential drivers, key drivers. One is changing stock values. So in the tech sector in particular, stock remuneration is a big part of compensation, or it has been traditionally. So there was a significant decline in tech stocks, ran up in terms of dollar value through really the beginning of 2022, and then fell rather dramatically over 2022. So that's one issue. And we did empirical work to see that there's a direct correlation. Companies whose stocks values fell the most were the ones whose payroll tax obligations fell the most on average, if you will, and in general. A countervailing effect that we saw, though, was work from home. So the tech firms have been bringing people back into the office, and we're able to track that. Using aggregated cell phone data, we can actually track activity into relatively small geographic locations, so we can track what's going on in different neighborhoods of the city, and see that again, with increased activity in office, there is a marginal increase in payroll tax revenues. So that's given us a basis for trying to forecast. We otherwise really had no knowledge of the tax base and what was driving it. So we've developed a model, and all credit to Jan on the forecast office team. We are using predicted stock values and trends in office behavior to develop the revised forecast for 2023. And then for 24 and beyond, we're using our regional model and what it shows in terms of the general growth in these sectors. So that's again led to the revision to 263 million, and then modest growth in the years that follow. So next slide. This slide is designed to highlight the fact that the revenue forecast for Jumpstart is reduced for 2023 and 2024. So the gray here, the November forecast, the black is obviously the 22 actuals, and then the April is the new forecast. So again, we brought the revenue forecast down for 23 and 24. We're expecting growth in the years, again, modest growth, consistent with the overall modest growth forecast. But that does imply that for the next few years, and this becomes an issue for longer term planning, notably less revenues really each and every year of the 6-year time horizon that are just used in some of the financial planning. So that will become obviously a budget challenge.
On this slide, thank you, Director Noble, and I didn't have a chance to make a suggestion, but perhaps this is for central staff for our future analysis. I think it would be helpful to look at the 2020 projected revenue compared to the November forecast and the April forecast. We tend to be very concerned when any revenue forecast comes in lower than anticipated. But in the context of our planning for 2023 and 2024 and a preview of our discussion to come with the central staff memo, it is important, I think, to have another bar on there. And perhaps it's on the central staff side for us to take off of the economic and revenue forecast plate. And as we look at this bar, it would be helpful to see what our 2020 projected revenue was, because my understanding is for 2023, for example, we were projecting that there would be about $220 million in Jumpstart revenue, and that's what we budgeted for. So it would be very helpful to see that for the out years, but just looking at 2023, for example, I think it would be helpful for us to put into context that the $220 million that we projected, that we budgeted for and held ourselves at that amount and used the higher than anticipated revenue, what was over 220, we allocated that to the general fund to help address the ongoing impact of the economic crisis due to COVID. And so that might give a sense of balance as we think about where the investments for Jumpstart were planned for up to 2020 up to $220 million from our calendar year 2020 projections, and have that paralleled with each of the years. So perhaps just a request for central staff. I see Allie giving a thumbs up. Okay, anything else on that, Deputy Director Panucci? Okay, thank you for making that possible. And I know it's probably a relatively easy bar chart to throw together. Councilmember Herbold, please go ahead.
Just a quick clarification. Sorry, Madam Chair, I know you said it very clearly, but just the actual budgeted Jumpstart payroll tax for the Jumpstart eligible investments, if plotted on that 2023 line, you're saying it would be equal to or above the April forecast?
Correct. And I'll turn it over to central staff.
That's really important.
It is really important, right? If I had a cursor to show you on the 2023 line, if we plotted, there we go, perfect. Allie's showing us the cursor there. If we had a 2020 projected revenue that we budgeted for in our 2023 calendar year expenses for Jumpstart, it still is coming in under the April forecast numbers. So we still have surplus Jumpstart funding that is currently still going back into the general fund per the agreement that we reached with the city budget's office and the mayor's team. And I see the cursor on the line there. So I'll turn it over to perhaps Allie to add any additional context on that.
Chair Mosqueda, that's correct. The estimate central staff made when the council was adopting the payroll tax in 2020 was about 214 million in the first year of the tax, and then we assumed about 2% growth per year. So for 2023, that's about $220 million of what was estimated and what was assumed for the spending plan conversation. So the budget that was adopted by the council in November of last year allocated about $220 million to those Jumpstart spending categories, and then anything above that was allowed to be transferred to the general fund. And so as right for in 23 and 24, there's a what we call the fund flexibility ordinance. And so with the Jumpstart revenue decreasing and the general fund increasing, you can see how that balance could shift, although there are other pressures on the general fund that we'll talk about in the next item and some of those trade-offs.
Thank you very much. Councilmember Herbold, does that help?
Very much. Thank you.
Thank you. And good morning, Councilmember Nelson. Please go ahead.
Thank you very much. I don't know if this is what Councilmember Herbold was asking, but maybe I'll try to rephrase it. I understand the importance of plotting the 2020 expectations for the performance of Jumpstart. That's fine, but we did budget according to projected 2023 and 2024 Jumpstart revenues. So so really that's what we should be working off of. What did we expect for Jumpstart in these current years, and what are we going to be getting? Is that sort of what you were trying to get at, Councilmember Herbold?
If I could just jump in, that's not accurate. We did not budget for the full Jumpstart projected revenue to go to only Jumpstart investments.
I understand that. Yeah. And
We-
you allowed for part of it to be used for general fund.
Right. So when we say that the importance of looking at the 2020, thank you. The importance of looking at the 2020 projected expenses is because in the years 2023 and 2024, we've only budgeted to that amount. The rest of the funding from Jumpstart does go into the general fund. And of course, Councilmember Herbold, I think that was a question for you, but I'll ask central staff if you have any technical corrections or anything additional to add to that.
Thank you, Chair Mosqueda. I think, Councilmember Nelson, I'm going to take a stab here at, I think what you are sort of asking for confirmation on is the full amount of projected Jumpstart revenues for 2023 based on the November forecast are budgeted in the adopted budget. $220 million is appropriated for spending consistent with the Jumpstart spending plan, and the remainder was budgeted to support general fund expenditures. Is that?
Yeah, I was
Yep.
I was just I was wanting to make sure I understand Councilmember Herbold's question properly, because yes.
I
this is a
simply wanted
temporary-
to, I simply was trying to understand the point that Madam Chair was making and echoing my agreement that we need to have a bar on this chart that not only shows the forecasted amount of Jumpstart and the both for November and April, but also what we actually budgeted for the Jumpstart spend plan expenditures. And that is a bar that's missing. And if we had that bar on this chart, it would show that it's actually below, it's less money than is forecasted in April to bring in.
Thank you. And
It's
I'll just note as well.
What was anticipated in 2020, I understand that. And temporarily, we allow for money to be used for general fund expenses as needed.
Excellent. Yeah, thank you so much. And I also want to make sure I again acknowledge that that's a request for central staff and not a missing component of this chart, given the independent role that our Economic and Revenue Forecast Office has. But given that we have the back-to-back presentations, this helps inform the councilmatic discussions with the executive about future budgetary actions. And we like to pair the Economic and Revenue Forecast independent report out with a status update on where we're at with expenditures and things like that on a quarterly basis, so we can have these very informed discussions. So thanks again, colleagues, for asking for that additional information and clarification. And we will follow up, I think probably in the immediately following presentation here on this conversation, and just wanted to acknowledge as well that the independent office of the Economic and Revenue Forecast, I brought this up, but you are not missing it. It's just a great idea for us to add to our central staff and council discussions coming up here soon. Okay.
Well, and we can talk further about, yeah, let's, next slide, move on, just conscious of time. So, so also want to talk about REIT, because the REIT forecast came down significantly as well. And I'm going to actually talk a lot from the chart here on the right. It's one of these charts that has got left and right axis, and it's measuring two things. So one is in the blue lines, it's showing actual and then forecasted home sales. The forecasts are in the slightly lighter color of the with the dots. So and what it shows in terms of volume of home sales is this very dramatic decrease that really kicked in the second half of last year. We went back, and we don't need to, but we put the chart that showed interest rates. Spike in mortgage rates led to a very sharp decline in the volume of home transactions. And that's forecast to maintain, again, with interest rates expected to be relatively high, it's forecast to remain at a relatively low level for the next few years, actually, as you can see. The black line is a home price index. So it's set at 100 for beginning in 2020, and it's measured on the right side. And what it shows is that prices went up more than 20%, and then and are expected to come down, but only come down slightly. So it's the taxes on transactions and the tax basis, the prices of the transaction times the number of transactions, if you will, it's a price times quantity thing. We're seeing in the blue lines, there's a lot less quantity, or a lot fewer sales. In the black line, it suggests that the price part of this hasn't changed as much as you might think. What appears to be happening in the residential market in particular is that there are relatively few buyers because the interest rates are so high, but there are also relatively few sellers, in part because the interest rates are so high. Because if you own a home and you're sitting on an existing mortgage with a low interest rate, you don't really want to sell to get out and lose that mortgage. There's also a lot of uncertainty about employment and the like for some folks. So there aren't a lot of buyers, but there also aren't a lot of sellers, and that's leading to relatively stable prices. They're certainly coming down, but they're not falling dramatically. What has fallen dramatically is the volume of sales, and it dropped off very quickly late in the second half of last year. On the commercial side, we're seeing also reduction in the volume of activity. There, it's a little bit of both. I mean, in terms of prices and quantities. In terms of quantities, just to give you a sense, we haven't seen an office tower sale, which would be well in excess of 100 million if one were to sell, a significant size one, in going on a year, which is unusual. There are enough buildings in downtown. A lot of them are owned by real estate investment trusts. They classically have turned over a certain number of them every year. But there's just so much uncertainty about the value of those buildings at the moment because nobody really understands what's going to happen with return to office in particular. So bottom line, we've seen a very dramatic decline in revenues, and our revenue forecast having taken in more than 100 million, I think, in 2021. Revenue forecast for 2023 is for 55 million, so essentially a 50% reduction in a short time period. And actually, to date, revenue streams suggest the revenues received through the first part of this year suggest we're going to struggle to even meet that lower forecast. We'll again provide you an update in August and determine whether that needs to be revised. But really dramatic effects on the real estate side. And again, REIT is used a lot for debt service, large capital funding source, and a lot of that capital is debt financed, which means there's relatively lack of flexibility in terms of on the expenditure side. But bottom line, that's what's happening to REIT, and this forecast is reflected in similar numbers at the state and the county level. So they're seeing the same effect, and their forecast revisions again have come down and come down dramatically. So.
Oh, sorry, Director Noble, I didn't mean to interrupt you. I was just going to add one more comment.
Yeah, no, I was about to wrap up, so please go ahead.
Okay, well, I missed my chance when we were having this discussion in the Revenue Forecast Council on the point of building construction slowing down, and wanted to make a plug for all of us who have the opportunity to work not only on the legislative branch side, but on the executive side, to do everything we can to expedite permitting and make it easier for places where we've already allowed for dense, taller buildings to be built to get those processes through. We hear stories of 18-month, 2-year, 3-year delays. And I know in the last year's budget, we tried to address some of that with additional capacity. So perhaps it's on us with the public policy pens, both in the executive and the legislative branch, to figure out ways so that we can expedite the construction of buildings if they're desired to be built by builders in areas that are already permitted. It seems like that's a good revenue generating option as well. So just wanted to make that comment because I missed the chance to say it in our revenue forecast meeting. It's not that we have a stagnant situation that's unchangeable. If there's levers that we can pull and push to ensure that more construction, if desired, can happen quicker, that seems like a good way for us to also enhance some revenue that is unfortunately projected to be down. Any additional comments? I think Director Noble, you said you're on your last slide here, or do you have more?
Yeah, 1 or 2 more.
Okay, let's keep going.
Yep. So long-term forecast for REIT, again, similar story that we're bringing down the forecast for 23 and 24, but also the longer-term forecast. And again, REIT gets, because it's a capital expenditure item, it gets programmed out for several years. So there are effects beyond just the biennium, and that's really the only highlight here. Next slide. And this is the last, and this is new information. So I promised that we'd come at the end here and highlight some of the things that that have developed since we provided the April update. So these are really more qualitative than anything. We had at the time, I'd mentioned earlier in the presentation, and it was apparent in April that there was some uncertainty and turmoil in the banking sector. for the 2 weeks after we did the April forecast presentation, the initial presentation, that had actually calmed. It had since picked up some. So again, there continues to be concern, particularly in the regional banks and some of the smaller banks. So less concerned about sort of a big run on banks, but more that it's the effect of this is going to make bankers nervous, and in particular lead to more stringent lending standards, which again means if they're not lending money, it's going to be harder for companies, or anyway, it's easily hard for companies to invest in capital, and the like. So that will have a drag on the economy. Some of that's what the Fed wants, and this is one way to get it. They don't want the banking sector to be unstable, but they do want, they were trying to slow down lending. The Fed did follow through with an increase in May. Expectation is that they are now going to hold at the 5 to 5.25 that they are at, and wait to see what happens. Persistent inflation would be a reason they might increase it further, but some had hoped they might not take this step, but they have. Other big news was in GDP growth. So the figures for first quarter came in, and they were annualized rate of 1%. That's actually better than is even in our April forecast. We weren't expecting even that level of growth in the April forecast, but it isn't. But we were expecting some growth, so it's not wildly off. And it is those realized GDP growth of 1% is consistent with the general notion that we are slowing, and that we are going to enter a phrase I mentioned in one of the previous slides. The slow session, so not a recession, but a slow growth period. So that 1% growth, which is quite low, again, that's an annualized number. That's consistent with, if not slightly ahead of the underlying forecasts. And then we've continued to add jobs. 250,000 added in April. So again, job growth continues to be strong. That's, as pointed out here, that's good news at some level. But again, the Fed is concerned that the job market's going to continue to become a driver of inflation itself, as employers are trying to find workers. So to wrap up on that, the economy was strong through the first quarter. So we continued to do well. But inflation is persistent, somewhat higher than forecast. And this financial market instability is creating concerns that again could tie up and slow down lending markets. And I guess the last one that I would add that continued to develop since I even drafted this slide a week ago is that we're getting ever more nervous, or I'm getting ever more nervous about debt ceiling and what it will take to get action on that, and the concern that we might need to see some level of distress in financial markets before some folks get motivated to raise the debt ceiling. Hard to know. Obviously, there's been no details, but some sense that there's been progress made. So overall, again, big picture, revenue forecast up for the general fund for 23 and 24, down significantly for both REIT and payroll tax over that same time period. And for all the revenue streams, slower growth over the period beyond 2024 than we had previously expected. And that's the presentation.
Okay, great. Well, thank you so much. We have spent an hour on this, but want to see if there's any additional questions before we go to the central staff's analysis, and would also just ask if there's any additional context that the city budget's office team would like to provide. Okay, Director. Oh, please go ahead, Jan.
Oh, this is Dave from the city budget
Dave,
office. Yeah,
I'm sorry.
just to say no real, but just to point out that the changes, the increases are relative to previous forecasts. But I'd like to remind you, when you look at those 2 years, 23 and 24, it's actually quite flat in terms of total amount of revenue available. So just a cautionary moment there, but thank you.
Thank you. Thank you, Dave. Any additional questions? All right, I am not seeing any. I know that this is dense material. Thank you for both being here to present it through to us. The slides have a lot of information on them. So if people have follow-up questions, you know where to find our Office of Economic and Revenue Forecast. And we're going to now transition to agenda item number 1, which will allow for central staff to take the information that we've received from the Office of Economic and Revenue Forecast and the city budget's office, and help to provide an analysis of what that means for our existing biennial budget and future years to come. And we look forward to continuing to partner with both CBO and the Office of Economic and Revenue Forecast as we seek to get additional information. I want to just give a quick heads up that the August forecast, right? The August forecast is traditionally more on target or more accurate than our April forecast. Director Noble, can you remind us when the August forecast meeting is again, if you have that at the fingertips?
I believe it's the 10th.
Okay.
But yeah, I'm getting a nod. I don't have my calendar in front of me. And yeah, just a reminder, this April update provides the basis for the budget office and central staff to begin planning for the budget process. The forecast in August is the one that underlies the mayor's proposed budget that will be delivered towards the end of September. And then we're going to accelerate slightly. We're going to give you the last update in about the middle of October, and that's to inform council's final deliberations.
Well, we appreciate that for sure, giving us additional time before the final budget is wrapped up for our November deliberations. And Director Noble was right. The next Economic and Revenue Forecast Council meeting, again, those are shared out publicly and projected on Seattle Channel. Information is posted the day of so that everybody receives it in real time between the executive branch, the legislative branch, and the community. It's almost like a press release of sorts to let everybody know we've gotten the information in real time. It is going to be August 10th, and that meeting is at 2 p.m. All right, thanks so much. Much more work to come, right, Dave, with planning for the 2024 calendar year as soon as we get that revenue forecast in August. So thanks in advance for all your work, and thanks for being here today.
Thank you.
Thank you.
Enjoy the rest of your day and evening. Madam Clerk, do you mind reading into the record item number 1?
Agenda item number 1, general fund financial plan update for briefing and discussion.
Thank you so much. We are going to turn it over to our central staff team. We have with us today Deputy Director Ali Panucci and Budget Lead Tom Meixel. And I want to thank you for the robust central staff memo that you provided to us. I did circulate that again to our council colleagues, including folks that are not on finance and housing, as we always want to make sure everyone is aware of the financial health of the city, and invite folks to attend these quarterly meetings where we do the report outs on not only on the revenue forecast, but on the important central staff analysis of what we've heard. So everyone on council has received that, and it is posted to our agenda as well today. I'm going to turn it over to central staff to walk us through this in-depth memo, and we'll have a chance to follow up on some of the questions that we started to insert into the discussion in the previous item, and we'll get into that a little bit more here. So welcome, and I'll turn it right over to central staff.
Good morning, committee members. I'm Ali Panucci, your Council Central staff again, and joined by my colleague, Tom Meixel. I'm going to turn it over to Tom to walk through the presentation, but we're both available for questions. And I'll just say what you have heard others say today, and you'll hear Tom say again, this is a update to the information that was presented and discussed during Council's budget deliberations this fall. You'll get 2 additional updates prior to adopting adjustments to the 2024 endorsed budget here, but this is a moment in time, and we expect that some of these numbers will continue to change as we get those additional updates and we learn more about changing assumptions about costs with city services and programs. And with that, I'll turn it over to Tom.
Thank you, Deputy Director Panucci. Good morning, Madam Chair, members of the committee. I'm Tom Meixel with your Council Central staff. If we could go to the next slide. Following on Deputy Director Panucci's comments, this is a regular update. So it's a process that began in committee last year, where when there are significant changes to assumptions around planning for the budget future, we then come to the committee and update how the outlook has changed for the general fund or any other significant funds of interest. So the outline for this morning's presentation will really kind of hit on 3 key touchstones as you go through. And you'll see, following from feedback from committee members in the past, that the presentation includes page reference numbers next to the title for every slide, so that you can dig deeper into the analysis, because the presentation is intended to just present the high points of the analysis, but there are sometimes deeper findings within the memo itself. But the 3 points that we'll cover this morning are a review of the update of the general fund financial plan, That update is going to rely on some updated estimates of how 2022 ended, which impacts the amount of money flowing into this year's budget. Updated revenue and expenditure projections. So you just heard a very in-depth presentation from the forecast office and CBO about the changes, the beneficial changes to the general fund, some less beneficial changes to REIT and Jumpstart Fund through 2026. Also, there are inflation changes that were discussed. Those have been layered into the model. And given that the Jumpstart Fund has an intersection with the general fund that we'll discuss this morning, and that the Jumpstart Fund's revenue projections are being downgraded in the most recent forecast, we'll have a discussion about how that looks and how that impacts the 2-year plan that was adopted last fall. And then as a closing, highlight some equity considerations given, and this kind of builds on the discussion in the last item about how the amount going for those equity programs is now lower than what would have been originally anticipated given the forecast for the new payroll expense tax back in 2020 when the discussion was taking place. So if we could move to the next slide, we'll jump into the details. Oh, actually, so this is just the kind of the high level caveat. This is a point in time. The numbers will change, though we are using the kind of underlying assumptions, baseline data and methods that are used by CBO. I do some calculations that recast some of the numbers to identify what the ongoing operating surplus deficit is. So that's kind of the operating gap for city government funded by the general fund. And these elements are not a foregone conclusion. There, of course, are deliberative discussions at council that can make changes up or down to any of the budget projections. This is just using a sort of current law approach, applying a set of assumptions from the resources that we have at our hand, and giving a sense of what the future holds for the general fund. So this slide kind of captures information that's covered in pages 2 through 4 of the memo. It does two things. It shows you in the circled area the 2-year budget. So just as a real quick refresher, why we do a 2-year budget, passed in 1992 in resolution 28885. Was where that council at that time endorsed a 2-year modified biennial approach to budgeting. So this essentially says that in even number years, the budget for the next 2 years is adopted in a cadence where there's an adopted and an endorsed plan. And so that's what happened last fall. In November of 2022, council passed an adopted 2023 budget and endorsed in resolution 32072 2024 budget. The parameters of this budget are that, as adopted in November, are that the starting balance for 2022 was $273 million, with an ending unreserved balance of $155 million, or I should say budgetary balance of $193 million that then carries forward into 2023. There's financial activity, revenues and expenditures that lead to an ending budgetary balance of $145 million, which then carries into 2024. And then financial activity planned for next year would bring the ending unreserved balance to $0 at the end. So this is the kind of snapshot point in time, the adopted and endorsed budget, and leading to a 0 ending balance at the end of 2024, indicating a balanced budget. We also include out-year projections, so they're less certain, but we use best available data. At the time when budget was adopted, it was estimated that there was, and this is shown in the blue line in the middle, a operating deficit beginning in 2025 and 2026 of about $212 million on average. So this is basically saying that the ongoing revenues are $212 are $212 million short of the projected ongoing expenditures in those years. As covered in the memo and as covered last year, there are a few discrete reasons for that. One is that the budget, the financial plan adopted prior to the COVID recession in the fall of 2019 actually included a $39 million projected deficit in the out years. So it's kind of a pre-existing condition that came into the budget planning that the council was faced with last fall. Also, the 23 and 24 endorsed budget includes some temporary one-time revenue support from the Jumpstart Fund. That's approximately $100 million in 2023 and $85 million in 2024. And then finally, some revenue categories just have not recovered to their pre-pandemic trends. Notable are court fines and parking fees. There is some indication that they are starting to recover, though they still are lagging behind. So given all the projections that we had at that time, the ending unreserved balance would have been, if this plan was to go to its fruition, be negative $425 million at the end of 2026. So building from this starting point, go to the next slide. I have layered in a number of changes that have occurred because it was a projection at that time, and now we have new projections. One of the critical things is to reassess how much money is available coming into 2023 based on activity in last year. And that is actually a good news story because the budgetary fund balance, so the money available to spend in 2023, I think improved by $168 million. It's a combination of revenue and expenditure changes, as indicated in forecast office projections. Revenues were $23.35 million below estimates in 2022, but that's more than due to unreceived grants. So Director Noble did touch on the concept of grants and how actually they were showing up in the 2023 forecast, and he had made an adjustment for those. So this is essentially the other side of that story, where it's the 2022 grants that had been built into the 22 budget, but that were not received. And then also expenditures for last year were $191.6 million below the revised budget. However, all of that, part of that expenditure budget, departments still intend to spend it. So after you make that adjustment for the amount that departments intend to spend, which we in budget terms call carry forward appropriations, there's still $34 million positive improvement in the unreserved fund balance. And with regards to the carry forwards, a large chunk of that is automatic. So these just are capital or things tied to grants that have been accepted. That's about $105 million, and that's just automatically done in the financial system. Another piece, and you'll see this later in this morning's agenda, is legislative carry forward. So these are amounts that are being re-requested by departments for the council to approve to carry forward into this year's budget. But the upshot of this is that the budgetary fund balance is better than expected. And of that amount, there's an extra $34 million coming into this year that's unreserved. So let's go to the next slide. Okay, so there's a few observations about the 22 activity that are important to touch on, particularly with regards to some of the concepts I'll talk about later, including higher costs this year and an interaction with the Jumpstart Fund. First, when you peel back the onion of the financial activity from last year, you realize that there was an underspend budget of about $57.5 million, which is 3.4% of the 22 budget after adjusting for carry forwards. There's a few details about that are interesting to know and to keep in mind when thinking about budget decisions. this year, including the mid-year supplemental and the year-end supplemental and the 2024 budget. One is that in last year's memo at this time, we identified that there was approximately $50 million underspend in 2021. So this is a fairly consistent with at least that prior year estimate of underspend. Next, the 2022 budget, so the balanced plan for the biennium assumed a $20 million underspend for 2022. So this actually outperformed that assumption on the order of $37.5 million. And then finally, the underspend for the current year is $10 million. And similarly, for the 2024 endorsement budget, it's $10 million. So the actual experience of underspend is some measure higher than what has been assumed in the biennial budget plan.
Tom, can you do a summary here? So the unanticipated additional 2022 unreserved ending fund balance was 34 million. How much more is that than we anticipated again?
$34 million. So we basically have $34 million more coming into 23 just based on advantageous financial activity in 2022.
Okay, thank you so much. $34 million. Thank you.
And thank you for the segue into the point. That number is interesting for a couple of reasons that we'll touch on later. One is that Ordinance 126719, which is the legislative vehicle that authorizes temporary use of the Jumpstart Fund to support general fund revenue shortfalls in 23 and 24. So in the current 2-year budget plan, allowed for an adjustment to the current year, so 2023's transfer to the general fund by whatever amount there was of extra money coming from the prior year. And so that by the read of Ordinance 126719, the funds flexibility ordinance, that would indicate that that the transfer could be reduced by $34 million. I will note that in discussions of preparing this information with the budget office, that there is, given the shortfalls described in the revenue forecast presentation earlier in the Jumpstart Fund, that they, to balance the 23 budget, part of their plan is to reduce that transfer by an even higher amount, by $38.7 million. So that is actually $4.7 million higher than what the funds flexibility ordinance would require. And there are more points on this. I'll cover those later when we talk about the Jumpstart Fund. But that's just one piece of how the funds flexibility ordinance interacts with the executive administrative intent, as told to us by the budget office.
So separate from the public testimony that we heard this morning about possible holds for 2023, you're saying that the Jumpstart Fund ordinance that we passed requested and directed that any higher than anticipated underspend and additional revenue that came in should go back to actually replenishing Jumpstart. So that's that, in addition to the need for us to, well, I would say that the agreement that was made for us to stay true to spending the 220 as the line that was being held from our 2020 spend plan. So the ordinance that was passed assumed that we would have money back filling Jumpstart, but besides that conversation, which I'm sure we'll cap it at the end of the year, we're at the point of worrying about the 2020 dollar amounts that were authorized in the 2023 budget not being potentially adhered to. I see Allie come on the screen here. If I'm not making sense, please let me know. And if I'm just trying to draw that point out, because I think that there's two different sort of aspects here, that the statutory obligation to pay back Jumpstart and the assumption in the budget bill that we would be adhering to the amounts that were codified in our budget and specified in our 2020 spending plan.
Thank you, Chair Mosqueda. I don't have anything to add, really, just to sort of restate what you said, sort of regardless of what is going on with the jumpstart revenues and the forecast update on that, by the ordinance that Tom just described, that $34 million by law should be transferred back to the jumpstart fund. And there'll be more on that later in the presentation.
Okay, thank you. I think we can continue.
Thank you. So that's the prior slide covered the 2022 adjustment to the plan. And now with the next slide, we'll start to talk about the changes to 23 and beyond based on new information. And the key driver of the new information is going to be the CBO or revenue forecast. And I do see a question from Vice Chair Herbold.
Thank you, Vice Chair Hubble, please go ahead.
Thanks. You may have already covered this, but going back to slide 6, I'm just trying to understand what guides our underspend assumptions for future years. It seems like we're assuming 10 million each this year and next, but our underspend has been 5 times that for the past couple of years.
Yeah.
So
which is also problematic. And we've been trying to get at.
Yeah, I appreciate Allie, your kind of boiling it down to what the bottom line is on jumpstart revenues, but I think it would be helpful to understand again what our assumptions are moving for future years and whether or not those are the right assumptions.
I cannot.
Yeah, please. I was going to say, I've heard Tom opine on this as well in the past, and I know that this is something that the central staff budget team and CBO, to their credit, has also acknowledged is not a great way to budget, right? If we are constantly not hitting the mark in terms of what our expenditures are, and we have millions in underspend each year that we're rolling over, that's not a great budgeting practice. So I know Tom's done some comparison with other jurisdictions, and would love to hear if you have immediate reactions to Councilmember Herbold's thoughts, either from Tom or Deputy Director Panucci.
Thank you, Madam Chair. Vice Chair Herbold, thank you for the question. Indeed, it's an item of interest. My financial planning background is always intrigued by this type of thing. The comparisons with other jurisdictions are perhaps less helpful in this regard because every city operates in a different way. I do know that the assumptions that were included for the adopted budget plan for the 2-year budget were what CBO was comfortable with at the time, and defer to their understanding of how the city's finances work. I do know that they have stood up a more enhanced fiscal monitoring program, which may bear fruit in this regard, to understanding what the kind of real-time read is on the underspend. All I'm doing is identifying the experience to help compare with the assumption what the actual amount that both the executive and the city council would be comfortable with is a policy choice, and in terms of balancing the plan, because you don't want to, if you budget too high of an underspend, then you sometimes will make it impossible to meet that target. A perhaps better approach would be to adjust your actual spending based on that information in the budget. One thing that occurs to me is that given that we have a couple of years of a fairly robust underspend, and given that there are challenges with regards to higher costs that we'll talk about, in fact, on this slide or the next slide, that there might be some intersection between the two where underspend experience in the prior year that can translate into higher than anticipated underspend this year can help balance out some of those cost pressures that are real, but that will need to be met. So it's an ongoing discussion. Again, the work is being done, and one hopes that it has a feedback into this year's process.
And I take from the comments as well, Vice Chair, that it's a good flag for us that even this dollar amount, even though it is a significant amount. It is maybe a conservative estimate of how much is available. So at least, $34 million in unreserved ending fund balance can be anticipated is the takeaway that I would have. I would just also want to note for the viewing public, it doesn't look like we have the slides linked on our agenda. So we will send those to the colleagues and make sure that they're part of our final memo that gets posted to the website for Seattle City Council, and colleagues will try to get that sent to you ASAP too. All right, Tom.
If we could go look at the next slide. Okay, thank you. So this morning we started with a updated revenue forecast from the forecast office's CBO. And it was a detailed discussion, so I won't belabor it too much, but in kind of summary, near-term revenue improvement, however, not much change in the out years. As was covered last fall, folks were expecting a recession, and that unfortunately has not happened. Though it seems that national forecasters keep pushing out the bad news, perhaps softening it some into the future. So all we know is what's happening today, and what's happening today is that general fund revenues are higher than originally projected. And unfortunately, the offsetting portion of that is that inflation also is being bumped up somewhat in the forecast, with the most acute bump happening in the current year. If you look at the memo, this is covered on pages 7 through 9. There's a discussion that compares the forecasts from the budget adoption time period with those that we're seeing now. And in 2020, so the current year, inflation is about 1.1% higher than originally anticipated. And it's slightly higher in 2024, projected to be about 0.5% higher. I will note that that there was higher inflation expected. So there was some measure of that in the budget plan for the 2 years and for the long term. So this is just a slight ticking up of those assumptions. But again, it has an impact in terms of how to accommodate that in the financial model, given that we're already in 2023 and that the financial plan builds off of a 2024 endorsed budget that was contemplated when inflation was lower. I've added an amount to the 2024 base to account for that in years. And that is really the most significant cost driver in the model is higher inflation. And I guess to echo some commentary from earlier, these numbers will be adjusted in the future in next iterations of the forecast. Most recent will be in August. And there was some reference to the improvement over time in the forecast, meaning that as we get closer to the actual year where we'll receive the money, the estimates get more accurate. There is actually a good report that was done by the forecast office about their forecast accuracy and those trends that is linked to their November 22 agenda. It's available on the web. It's a useful read to show how the accuracy does improve. The good news is over time, the numbers get better on average unless we go into a recession. So that's, I guess, if there's a note of positivity, that's what I would add to the presentation is that in past experience, the numbers have gotten better, though we're always, in the business of predicting the future, there's always an element of risk. So that covers the kind of inflation and forecast adjustments. There are just a few other ad hoc items that were either legislation that's been passed. So Council Bill 126791 was the first quarter grants acceptance ordinance. There was about $7 million of revenue and expenditure that was accepted in that bill. So that's kind of a neutral adjustment. Also, a few technical adjustments that are covered in the memo. They're fairly minor. One is $600,000 of a revenue decrease that is just essentially paying back some city funds, city light fund, utility funds for costs for the revenue that they paid to the general fund kind of central services. So like things like CBO and the mayor's office and council, that those actual costs were lower than what they were charged. So it's called a 6-fund rebate. And then also there's a technical adjustment. There was essentially in the year-end supplemental last year, there was an item in FAS that should have been coded to a capital project, but wasn't. And because it was not, that was a miss, it wasn't automatically carried forward, and it should have been under standard practice. So that will likely be in the mid-year supplemental. It totals about $1.47 million. And I would just note that in kind of the technical review of the memo, that was a typo. So the memo says 1.6, and that number actually should be $1.47 million. And then finally, there is a $4 million add in 2023 that is just based on information from the budget office about some contingent cost factors that they are trying to account for. And there may be other items as well, but these are the ones that were available to us at the time of providing this plan.
Okay.
So this covers information on pages 9 through 10 of the memo. This just updates what the operating gap looks like. And as you can see, the operating gap in the out years has gotten worse. And this is because even though near-term revenues are better, forecasters do not feel necessarily confident that there's going to be much improvement over the long term. And then also because of inflation, the long-term costs are increasing. So that's the reason why the operating deficit goes up from 212 million to 224. But again, this is just a point in time, and we'll reassess this number in August. And then the final wrap for this is really the point of how much money is available and when. So if you look at the blue line in this graph is the kind of the ending unreserved fund balance. So how much money is there to spend in each one of these years. And then comparison is the numbers that are coming out of the May update. And as you can see, in all years, the number is higher. In 2023, so the revised estimates that we have put together for today, there's about $31.8 million more. Interestingly, in 2024, that number increases to $53 million. So if you look at the 2024 projected time period, that the original forecast was for a zero. So basically a zero balanced zero budget. Now there's actually $53 million positive. Again, the number is under development, but it kind of offers a little bit of extra buffer in that second year for any sort of contingent expenditure categories, some cost increases that might have been missed in this update and that would be revealed during the executive's process of developing changes for the 24 endorsed budget. And I will note that the ending balance at the end of 2026 has improved from $424.7 million to $394.9, but in order to actually have that come to pass, and it wouldn't come to pass anyway because the budget must be balanced in each year, but that would require that the money available in 2023 remains unspent, which given cost pressures is probably less likely.
Thanks, Tom. I would just add here, channeling a little bit Director Dingley from the budget office that while this is indicating some additional resources in the short term, the city budget office is seeing sort of certain lines of business that there will be increased costs that they're estimating for 2024. So while in the short term, it does look like some resources are available, it may be needed to support the expenditures already programmed in the 2024 endorsed budget.
Thanks so much. I would also echo that specific to the general fund. The general fund is not being solved by the slight uptick in general fund expenses coming in, but that's a fair point for us all to remember. And I think it also underscores the need for us to continue to have successful conversations at the revenue stabilization table, given the out years that are being shown in the charts that we've seen for 2025 and beyond. But it also is a good reminder for us that we have many revenue streams that need to be reevaluated. We talked a little bit about the parking revenue, for example, today, and ways for us to create more stable revenue sources is always needed. And we, I think, are going to have more conversation coming up here about Jumpstart. But as a reminder, Jumpstart was never intended to be the backfill to general fund. Jumpstart has a specific spend plan that's codified in statute, and in good faith and through negotiations with the executive team, we offered flexibility for the higher than anticipated revenue, specifically 2023. Any revenue that was over about $220 million could be allowed to temporarily go into Jumpstart, to go into the general fund to address for general fund dollars being down. Now, general fund dollars are starting to come back up. And if you can imagine swapping out the color of money, where Jumpstart declined by about $62 million and general fund was up about $68 million, swapping in general fund for where Jumpstart had supplemented for general fund expenses makes a lot of sense. But there is still this ongoing need for us to continue to look at out years and especially the stability and the fiscal health of the city 2025 and beyond. And we're going to have some conversations here, I think, about the 2023 current calendar year budget and our 2024 second part of our biennial approach in just a moment. But none of these years was it ever intended that Jumpstart would backfill and be the holding place for dollars to be used for future general fund investments either. Do you have additional slides, Tom?
I do.
Okay, and I just want to remind our colleagues, Deputy Director Panucci sent the slides to members of the committee yesterday at 5:22 p.m. We will go ahead and recirculate that email to all members of the council now as a reply all to the email that included Tom's memo that we sent around yesterday.
So I'll wrap up the general fund here. I covered most of these in the last slide with regards to the key takeaways, but with regards to how much money is available in 2023 and compared to the adopted budget plan, there's about $31.8 million of additional money available in the general fund. And just one key point, since we will be talking about the Jumpstart Fund, given revenue pressures and the payroll expense tax, that this $31.8 million is net of the administrative reduction to the transfer from the Jumpstart Fund to the general fund. So a portion has already been accounted for. So this is net of that transfer. But again, just to wrap up, the projected annual deficit in the GF, based on the projections that we know now, has worsened, but those projections will change as we receive new data in August. And that the executive continues their typical and standard work on compiling what the revisions are planned for proposing in the mayor's changes to the 24 endorsed budget. And now let's look at
Tom, can I ask you a quick question? Just because we spent a little bit of time talking about the 2022 underspend in the end fund balance. Can you talk a little bit about the $34 million number compared to this $31.8 million number and the 2 years? Which number should we be looking at as we think about what might be available for this year and next year?
Thank you for the question, Madam Chair. So the $31.8 million number is the number that we could use because it includes the impact of all of the various changes. The $34 million is just what starts. It's the first change from 2022, but as I covered, there are other changes affecting both revenues and expenditures in all years of the biennial plan. So the best way to look at it is to see how much the unreserved ending fund balance at the end of 2023 changes, which is $31.8 million. So that is the number. That's the number to target at this point in time for extra money available in 23 in the general fund, after accounting for some elements, including the administrative transfer reduction, $4 million of contingent elements identified by CBO, and a few technical adjustments. So that's how the numbers all hang together. But really, the key number to look at in this analysis is the change in the ending unreserved fund balance, which is again $31.8 million.
Thank you.
Okay, so given a couple of unique characteristics in the biennial plan, and that there is a balanced biennial plan that was adopted and endorsed last fall, it's incumbent to look at the Jumpstart Fund, given that that is one of the funds with an intersection with the general fund on a temporary basis, wherein the Jumpstart Fund provides revenue support. This is the adopted Jumpstart Fund budget that was adopted last fall. It shows the starting balances coming in. So there was zero starting at the beginning of 2022. And then a number of revenue and expenditure projections, kind of all bottom line going to an ending budgetary balance of $19 million. I will note that there were also additional reserves that are layered in there. Those are not necessarily policy reserves. There's no policy stipulation on those, but those are kind of based off guidance in conversation with the budget office about what reserves might help for this size of a fund. If you look at the broader financial plan in the city budget, you'll see that beginning in 2025, the ending unreserved balance is positive in the out years. But really the key metric for this analysis is the ending budgetary fund balance, which is positive in both years. Unfortunately, these are the revenue projections from last fall. And as we know that those, if we can look at the next slide, those projections have changed. So on average, the change from 2022 through 2024 is about $28 million, so lower revenues. The actual activity, so there was actual spending that was lower than budgeted in 2022 of about $107 million. 101 million of it is for carry forwards. So again, there's automatic carry forwards, so items that are for encumbrances or things that have some legal reason that they automatically carry forward to the next year. And then the bill that you'll hear later this morning will have a request for $55.1 million of carry forward of Jumpstart Fund monies into 2023.
Is the $55.1 million in carry forward requested in the upcoming carry forward ordinance a good example of what the vice chair was referencing in terms of the underspend in actuality, our practices much higher than 10, even $20 million a year. So $55.1 million in carry forward, is that a good example of where we see a conservative estimate on how much carry forward will be versus this actual being 55.1 million?
Thanks for the question, Madam Chair. So though they kind of are from the same place, they're kind of two different things. So the carry forward is going to be money that was not spent, but that shall be spent. And it needs to either be automatically carried forward to meet some invoice payment that is expected, or to just fulfill some program purpose. So in this context, the $55.1 million is the latter. So there's that amount in the Jumpstart Fund that is for a thing, for a purpose in the budget that just has not yet been spent, but it does intend to be spent in the current year. Underspend kind of also deals with expenditures. However, that is money that is just strictly was budgeted and is just not spent for the purpose. So a really great example of this is salary savings. You have money in the budget to pay for a salary, and the incumbent of that position leaves 3/4 of the way through the year, and so you have 1/4's worth of salary that has not been spent, and that money just drops to the balance of the fund. And so that's kind of the difference between the two, though they both deal with monies that were not spent in the prior year. It's the key difference between them is that in one case of carry forwards, the money will be spent. In the case of underspend, the money will not be spent and it drops to balance. So in this regard, the $55 million is not not related to the underspend in the general fund. Two different funds, two different size of expenditures. And plus, this is for a carry forward as opposed to just strictly money that will not be spent. And I see a
Right, so
question.
the 31.8 is the more accurate number to look at to make that point that was described earlier.
Actually, Madam Chair, the general fund underspend was $57 million. So that would be the amount of money that was not spent. That was partially offset by revenues that came in lower than expected, and so that's how you get to the $34 million.
Okay.
But I do see a question from Councilmember Nelson.
And before we go to that, I just want to flag for folks, we do have 2 additional agenda items that include a possible vote. So is it possible to keep you all till noon? Noon? Okay, seeing nods. Councilmember Nelson? All right, we'll turn it to Councilmember Nelson. Please go ahead, Councilmember.
I think that's okay, but I need to check my bosses here. But anyway, I'm stuck on the $107 million underspend, because when I look at page 11 of your memo, central staff's memo, it says that the revenue forecast based on the April 2023 projection, the 2022 actual jumpstart revenue will be 253. And so if we've got an underspend of 107 million, that leaves we've only spent about 146 million, and you just mentioned salary savings for positions that are funded by the Jumpstart Fund, I'm assuming, not all the other salaries. What else is driving that underspend? I mean, I'm just, and maybe we could have this offline, but that just seems like a lot of underspend.
Thank you for the question, Councilmember Nelson. So this is perfect because it relates to the prior question, the difference between money that hasn't been spent, that will not be spent, and money that hasn't been spent but will be. And so in the actual bullet under 2022 actuals, of that $107 million from last year that hasn't been spent, 101 million is intended to be spent either through an automatic carry forward process or through the upcoming carry forward bill that will be discussed this morning. So in kind of with that in mind, the difference between 107 million and 101 is the actual money that goes to balance in the fund. So that is the unspent appropriation that just drops to cash balance in the fund.
Well, I get that. It's just that was last year. So we didn't spend almost half of the revenue. So are we being overambitious in what we think we can get out the door with these dollars? That's kind of where I'm coming from.
Councilmember Nelson, we can look more specifically at exactly what makes up that $107 million. I don't have all the information in front of me right now, and I'm sharing my screen. So, but what I will say in general is that the Jumpstart Fund and the expenditures that it is supporting, the programs and services, are relatively new. So some departments will be a little bit slower in the first few years in getting money out the door as the Office of Economic Development establishes new programs and staffs up and gets those dollars out the door. So I wouldn't expect in the long term, like if we continue to see this level of underspend from the Jumpstart and carry forward on the Jumpstart Fund, I think that would be worth revisiting. In the first couple of years, I don't think it is that unusual to see sort of money carry forward, and particularly because a big portion of the Jumpstart funds is for things like capital investments in affordable housing and the equitable development initiative that often take a little time to develop those projects and start spending down the fund. So we'll follow up with more details on what's made up, but in the first few years of a new fund and new programs and services, I don't think it's that unusual. But if we see this 2 years from now, 3 years from now, I think that we would want to revisit what can reasonably be spent in a given year.
And Councilmember, I appreciate that question. I would love to work with you as well on that, because I know that one of the categories where we've seen kind of a hold pattern for wanting to have more input from the department and community has been in Office of Economic Development, and thanks to Markham and the department over there, they have a blueprint, right? A blueprint now for how to spend those dollars going forward. So a lot of the early investments in economic resilience category had been temporary investments as the department worked on what that overall blueprint would look like. So I'm really excited about the future work to come on economic resilience through the department that you have purview over, and would love to talk a little bit more about how we make sure that those dollars really are going in and out the door quickly. But I think it's a great example of making sure that we had a blueprint for deploying those dollars that was really informed by conversations with small businesses and community members, which they've done a great job of doing. So looking forward to talking more with you about that and with Director McIntyre as well. Okay. And thanks to my colleagues for your willingness to stay another 30 minutes. We will endeavor to wrap this up with additional questions and get to the other two items. And I would just also say, if it's accurate, Tom, there's no action today. This is an overview that allows for us to have more conversations, especially in June and July, and hopefully more deliberations to come with the mayor's office and CBO as well.
That is correct, Madam Chair. This is just information to help as spending bills come across to committee for the remainder of the year. So to kind of wrap up from the prior slide, the negative revenue forecast resulted in a negative ending budgetary fund balance. So the biennial plan in the Jumpstart Fund was no longer balanced. There are a couple of administrative measures based on these are intentions of the executive. One, as I covered earlier, is to reduce the Jumpstart Fund transfer to the general fund by $38.7 million this year. And then also there is a directive to underspend a few departmental appropriations in the 23 budget, totaling about $14 million. OED, the Office of Economic Development, $2.2 million reduction. Office of Housing, $9 million reduction. Office of Planning and Community Development for $1.3 million reduction, and Office of Sustainability and Environment of $1.3 million reductions. All of these would be administrative measures. The council sets the amount of the appropriation, though the executive can underspend. So each one of these can be done administratively. If they are done, and one final measure. This kind of gets to just like a change on the spreadsheet, which would be to reduce the 2024 reserves to zero. They wwere building up to a fairly sizable amount in the financial plan. And so given the revenue pressures, they would make the reserve zero in 2024. And then finally, for 2024, given that there is still a negative unreserved balance, there is CBO budget instructions given to departments to reduce Jumpstart appropriations, to prepare proposals to reduce appropriations for 24 by 15%, which would generate about a $46.4 million reduction if they were all done at that level. However, it's not known which, if any, one of those would actually make it into the mayor's proposed adjustments to the 24 endorsed budget. One point about these, I did say that they are administrative measures, though council could choose to legislate one or all of them in the current budget at the discretion of council. I just wanted to make that point. They do not need to be, though they can be, to express the legislative intent and also to help track the interaction between the Jumpstart Fund and the general fund, perhaps.
Question from Councilmember Peterson.
Thank you, Chair Mosqueda. This slide seems really important to me, especially since we heard from some speakers today, public speakers concerned about what appears to be a unilateral hold on money that the City Council authorized in this calendar year when we have only 7 months left in the calendar year. So it seems like there could be other ways to find $14 million than not following through with what the majority of the City Council authorized just a few months ago. I know in my district, a couple of years ago, there was a hold similar to this, where now the northeast branch of the library does not have a cooling center. So there were heat waves last year. There are going to be heat waves this summer. Because of a hold, it actually missed 2 summers of trying to get that investment completed for the community. So I'm concerned about a unilateral hold by the executive branch on things the city council authorized, especially when it's $14 million. It seems like that could be dealt with a different way. We are hearing from constituents who are concerned about this as well. So is there a way to, you talked about legislating to adopt these holds, but is there a way to legislate to require the spending? Seems like we already did that in November.
I'll take a first shot at that. Ultimately, as Tom described previously, the council's authority is to set the level of appropriation. One option the council could consider is legislating a bigger reduction to the Jumpstart Fund transfer, so that there would be you basically reduce the Jumpstart Fund transfer to the general fund by an additional $14 million because there are general fund resources available. And then there could be funds available to support that $14 million. Although I will say that the executive still has the administrative authority to require these underspends. The other option available and also requires agreement with the executive is that there is $14 million sitting in the Jumpstart planning reserves. The council could request the executive to use that $14 million to support the 2023 expenditures, knowing that as you go into the 2024 budget adjustments, you may have you may need to reduce some Jumpstart funding or general fund spending to fully balance, just because these numbers will continue to change. But I do think there are options available to hold to the 2023 commitments. And this fall, you all will be engaged in a conversation about what adjustments you want to make to what you endorsed for 2024.
Thank you for answering. Thank you for answering that. I look forward to working with my colleagues here on the second floor on this.
Thank you very much, Councilmember Peterson. I too want to underscore the importance of that legislative approach that we could take on this. I'll remain ever optimistic that the executive and the legislative branch can find a compromise to move forward to allow for the 2023 expenditures to remain in place. I'm very concerned that a hold has been indicated to the departments to the tune of what you're seeing on the screen. $9 million in affordable housing means $9 million less for the spring NOFA for rental housing production. $2.2 million in economic development when we're trying to open up small businesses and help small businesses stay open, not only in the downtown core, but in pockets around our city. It also includes workforce development investments, and whether or not those dollars had been promised and already almost out the door, or we were about to plan for how to get those out, that is a reduction in funding that could directly go to small business and economic resilience. And the same is true of the $1.3 million reduction that goes to our equitable development initiative and sustainability in the environment. Councilmember Peterson just gave a great example of when projects that are not yet underway get placed on hold. The implication could be years later, we're still waiting for cooling centers and economic or environmental justice strategies to be deployed. And we know that the Green New Deal investments was a key component of why and how the community came together to create such a robust coalition that asked for the spending categories. And I would also say the spending categories were not controversial. Unanimous agreement amongst council and signed into statute to make sure that these four categories really stayed true and were held harmless. And I would love to continue to have conversations about how to make sure that both the executive and the legislative branch are able to continue to fulfill these commitments that we made to community, especially not responding to an April forecast that has traditionally been off compared to our August forecast. So as we continue to see even the April forecast, even with the reductions in general and in Jumpstart being slightly lower, we are still projecting to be in the surplus, having more revenue from Jumpstart than the expenditures planned. And to me, putting on hold $14 million in the Jumpstart's expenditure plan for 2023, while we have 14 million in Jumpstart reserves and 31.8 million in possible funds available for us in 2023, given the underspend, we have sufficient funding to cover a $14 million hold in this year. And I think broad commitment to want to work collectively once we see those August forecast numbers to more accurately project how we need to address any 2024 reductions. But to me, this is about maintaining our commitments, staying true to our promise, and keeping our word when there's been a good faith negotiation between the branches on how we would use higher than anticipated Jumpstart revenue to support the general fund, maintain our commitments to investing in Jumpstart as codified in 2020, and then helping to find those solutions. I don't think anybody's saying we want to be rigid and say no. If we offer flexibility for the Jumpstart reserves, if we offer flexibility in how much needs to be paid back into Jumpstart at the end of the year, if general fund continues to grow, those are two possible ways that we can help find common ground to meet in the middle without holding back on funding that could result in less affordable housing production, Green New Deal investments, economic resilience, and equitable development investments. So I'll have more to say about that in a minute, but I just want to underscore the importance of us wanting to work collaboratively with the executive and the mayor and the CBO team to find that approach to make sure that $14 million is not withheld this year. Given, as Councilmember Peterson said, these were just decisions made a few months ago, and we have other pockets to lean into, whether it's Jumpstart reserves or whether it's the underspend for 2023 that we're projecting. There's a way for us to move forward this year and also collectively plan after we see the August forecast. Council Member Herbold, Vice Chair, please go ahead.
I don't want to be repetitive, but I do agree with Madam Chair and Councilmember Peterson that there are many levers that we have available. Jumpstart reserve, greater than anticipated general fund revenue for 2023, the underspend from 2022, the assumptions around future underspend. There are a lot of levers here that we can work with to address this, with an understanding that these are all questions that we should and will revisit with the August revenue update.
Right. Thank you, colleagues. Please go ahead, Tom, if there's additional material that you'd like to cover.
Thank you, Madam Chair. So this just wraps up what, if the executive's administrative measures were the only plan applied, how the budget would look. Just to touch on a few of the points that were in the discussion, there are alternative ways to tackle this, including making the reserve in 2023 zero, and making the underspends, the administrative underspends, zero would solve it. Or increasing the administrative transfer reduction to the general fund by $14 million and reducing the administrative underspend. So those are clearly options that are on the table, particularly given the higher than expected amount of money in the general fund this year. And that actually is a good tee to the next slide. And a lot of these items have been, kind of the core of the discussion this morning. But given that council and the mayor recently passed ordinance 126799, which actually codifies the city's commitment to racial and social justice, it's kind of incumbent on this type of analysis to look at the equity trade-off. So the Jumpstart Fund, when it was passed in 2020, or the payroll expense tax and the spending plan that accompany it were passed back in 2020. It essentially levies a payroll expense tax on some of the largest businesses in the city for some of the largest tiers of compensation expense. And then it allocates that money for a series of equity expenditures, including affordable housing, environmental improvements, equitable development, and economic revitalization. So So that is kind of one of the most progressive funds in the city treasury. I would note that after applying the 2023 administrative reductions in the executive's proposal, that the actual 23 revised budget would be below the amount that was envisioned for that year in the original spend plan. And the original spend plan, as you noted, Madam Chair, was based off of a lower revenue estimate that it still holds even to this day in terms of expected revenue. So it's kind of putting the pressure all on the Jumpstart Fund with less pressure on the general fund, particularly acute given that the general fund appears to have additional resources to deploy in the current year. And I believe there might be a final slide. No, there isn't. But that's the key point, is that there may be other ways to tackle this challenge to keep the integrity of the biennial plan without having that come at the detriment of the equity investments in the Jumpstart Fund, particularly within the framework as proposed when the tax was originally passed back in 2020.
Thank you. And thanks for bringing up the equity framework and the need for us to continue to look at how those organizations and communities that have had less investment historically have maybe less capacity to quickly respond and deploy the dollars, how we can ensure that we're still following through with our commitment to make those investments when needed. Allie, Deputy Director, I was wondering if you had the chance to work any magic on the question of the bar chart, or if that's still in development. I'm seeing some nodding. Tom, thank you so much for your presentation, and thanks for the slides to correspond with the 16-page memo that you sent around. That's very helpful. We will again get those posted to the final agenda that goes up online.
Okay, I do have it ready. I will just admit it's not the prettiest of graphs, but I will just go ahead and do this in real time, just the same. So this chart is showing, I think, what the committee was requesting. And do I need to zoom in more?
You do need to zoom in more.
Okay.
Thank you for doing this, though. We love to see an Excel chart in raw form on Seattle channel, so thank you. Yeah, it just needs to be centered a little bit more and zoomed in. A little bit more. That's looking pretty good.
Okay, and I will share this around and we can add it to the committee materials, but the blue lines starting in 2022 show what the Jumpstart Fund revenue estimates were in 2020. The orange lines, the orange bars are what the November forecast was, and the gray is the April revised forecast. And this lighter blue line going across is just sort of showing how those the November forecast and April forecast both show projected Jumpstart revenues coming in higher than what was anticipated in 2020 when the budget was adopted.
Well, thank you so much for working quickly to provide that visual of what Councilmember Herbold and I were articulating. I think that this also echoes what we just heard in the letter that we received from some community partners. And in the letter that's been circulated, it says, we clearly understood the agreement in the fall budget process to allow Jumpstart to temporarily fill a gap in the 2023-2024 general fund as predicated on two commitments. One, that we maintain the $220 million investment in the baseline Jumpstart categories estimated to be available when the council passed the ordinance in 2020. The council passed a spending plan with moderate growth projections of 2% per year. So at least for 2023 and 2024, we have held ourselves at that blue bar there and put any higher than anticipated revenue back into the general fund, with the hope that when additional revenue comes around in 2025 and beyond, that the full received investments from Jumpstart will go back into fully funding the spend plan. But we had temporarily allowed for that flexibility. And the second component was that, according to the letter, we replenish Jumpstart's equity investments if general fund revenues are higher than assumed in the budget. Holding back on $14 million in Jumpstart revenues this year violates both principles, the letter from community said. So I think that that's an important visual, and appreciate Vice Chair Herbold and in request for that, and my suggestion as well. Thank you so much to central staff for crafting it. Vice Chair Herbold.
Thank you. So the letter you just read from Madam Chair gives I think, a clear articulation of the understanding of the agreement with the executive and the principals. I recognize, of course, that the Budget Director Dingley is not with us here today, but is there anybody who can characterize the executive's interpretation of the agreements that we made during budget?
And I'm not saying anybody jump in and to
I've heard there's a difference, and I would just be helpful to understand that difference.
and if there's a difference, that's very frustrating, right? At least from the chair's perspective, because I definitely said multiple times in community and here on the dais on Seattle Channel that we had an agreement to continue to maintain the 2020 spend plan investments for 2023 and 2024. Repeatedly talked about how we were going to hold those lines and you only use higher than anticipated revenues for the general fund. So my hope, and Vice Chair Herbold, and it's a fair question for CBO, my hope is that this is still an ongoing conversation with CBO and the mayor's team, and that we can revisit what that discussion was and how we will continue to move forward, especially as you noted, given the reserve funding of 14 million for Jumpstart and the 31.8 million in unprogrammed and underspent dollars in 2023. And I still see central staff on the line too, so not to put you on the spot, but in lieu of having an opportunity to have that discussion with CBO today, is there anything else you'd offer from a nonpartisan technical perspective on what we discussed during budget?
Yeah, thank you, Chair Mosqueda. I can't speak for the executive or what their understanding of the agreement was. What I can say is that this has been a consistent challenge each year since the Jumpstart tax was adopted. And so I would just point to the legislation that was transmitted with the 2023 proposed budget related from the executive for the Jumpstart Fund, which would have ensured first that the general fund transfer was protected before Jumpstart spending was protected. And ultimately what the council adopted was ensuring that the Jumpstart spending at the 2020 estimated numbers were protected, and then anything above that goes to the general fund. So I would say, while I can't speak for their understanding of the agreement, I would say that since July of 2020, each year we have received legislation that sort of is in that spirit, which is prioritizing ensuring that the general fund is balanced, and for reasons, related to maintaining those core services and that sort of thing. And the council has consistently passed legislation that has protected or held true to the commitments in 2020. And I'll also just note that the city budget office, as I said earlier in the presentation, is facing increased costs. And so I think to be fair to what they are trying to balance here is that they are seeing that to avoid cuts in the future to services and programs, they are trying to reserve some resources. So there's some flexibility for your decisions in 2024. And these are just, hard policy choices in a resource constrained environment.
Thank you. I think that, to be fair to us too, and I don't want to speak on behalf of the council, but I think that we've also been willing to show flexibility in how we solve for the revenue gap. And I think the request continues to be to allow for the 2023 expenses to move forward, given that we have 14 million in reserves for Jumpstart alone, not to mention the 90 million combined total for the two other emergency reserves that we have. We have 31.8 million in additional general fund that could be available given the projected underspend. And I think that there's an opportunity for us to allow for 2023 expenses to move forward, and then revisit this conversation in August when we see the full revenue forecast and identify where we collectively can offer additional flexibility. Whether that's with repayment to Jumpstart or using the Jumpstart emergency funds, I think there's an opportunity for us to have more deliberations with community as well as with the executive about how to address any shortfall that we are seeing for 2024, given that we all know that there's increase in costs, but want to stay true to the expenditure plan as noted. You know, $9 million in holding back in affordable housing means that critical projects that could be spent on rental production might not go forward. And while we could potentially build that back in August, it's not a real equitable way to apply funding when there's existing dollars available to close that gap. 1.3 million in equitable development funds means reducing investments or delaying timelines, and that also equals additional cost for EDI. And in Green New Deal investments, again, these are mostly dollars that are helping to spur local responses to the environmental crisis that we're seeing, and ideally would be paired with federal dollars and other dollars. So any delay there, I'm worried about a slippery slope and a declining investments in our community. So I look forward to addressing this with the executive. I'm hopeful that we can continue to have these conversations with CBO. I'm committed to identifying ways that we can close gaps that are identified in the August forecast, and also committed to that long-term revenue needs. I am hopeful, colleagues, that we can come back and follow through on what I hope were good faith negotiations. At this point, it feels like a walk back on those conversations and agreements that we have. It feels like a betrayal of the conversation that we committed to community, that we would hold true to the 2020 spend plan, which was $220 million in 2023 from Jumpstart. And we're also realistic that we need to address any revenue gaps that continue to persist in the August revenue forecast. But given the revenue streams that are potentially even available at this point with underspend and our Jumpstart reserves, I'm very concerned about this. So looking forward to having those additional discussions with CBO, with the mayor's team, and with the community at large. Colleagues, is there anything else on this item before we close out? Okay. Tom, thank you very much for that summary. Director Panucci, thanks for your work as well. Thanks for the quick analysis on the bar chart, and we will get that sent around. Especially interesting to note that we are still seeing Jumpstart revenues come in higher than what is planned for expenditures in Jumpstart, even if we don't reduce it by 14 million in 2023. Very important. Colleagues, I promise you this will be fast. Central staff is with us. They have indicated these are short presentations on items 3 and 4. So for the sake of time, let's go ahead and read items 3 and 4 into the record. And we have Eden with us to walk us through it.
Agenda item number 3, an ordinance amending ordinance 126490, and agenda item number 4, Council Bill 120573, an ordinance amending ordinance 126725 for briefing, discussion, and possible vote.
Thank you. And Eden, thank you for being with us here today.
Thank you very much. I will, like you said, keep this, I'll move very swiftly. So good morning, council members and chair. I guess it's morning, one more minute. Eden Sisich with Council Central staff, and I'll provide a quick, so if you move to the next slide, yeah. I'll provide a quick overview of how the city's budget gets adjusted throughout the year, starting with the adopted budget, including automatic carry forwards, which I'll explain shortly as well, and then supplementals, which occur throughout the year, and the exceptions bill, which gets submitted after the year is complete. Then we'll get into some specific details and highlights of the carry forward and exceptions bills before next steps in terms of upcoming budget adjustment processes. So I'll cover all of these slides much quicker than I was expecting for the sake of time. But so by state law, we're required to adopt a budget 30 days prior to the beginning of the ensuing fiscal year, which we did on November 29th last year for the 2023 fiscal year. And that adopted budget across all sources was $7.4 billion. And also, while the budget adoption document includes a reference to multi-year CIP program, only the first year of capital investments are appropriated in the budget adoption itself. So next slide, moving into the operating phase of the 2023 budget year, automatic carry forward takes place, and that's sort of a technical adjustment which accounts for all automatic carry forwards. And from this slide, the biggest takeaway here is that there's a $1.9 billion automatic carry forward into 2023 across all city funds. 2/3 of which is in capital budget, which is just about the same as it was last year from 21 into 2022. Slide 4, thank you. So the next piece, which is most relevant to our conversation today, is regarding supplementals. State law allows supplementals to take place, and I've provided a bit more detail on this in the memo on page 2. But we categorize them as standalone, which are more specific and single subject, or comprehensive, which is what we're talking about today. Those are more of a package of adjustments that affect multiple funds across multiple departments. So we can move on to slide 5, please. So this table summarizes at a high level the city's 2023 revised budget, starting from the adopted budget and accounting for all of the changes to date. So our 2023 budget, again, is $7.4 billion, with an automatic carry forward from the prior years of $1.9 billion, and the bulk of which is in CIP ongoing programs. And then we've had 4 standalone bills and 1 comprehensive bill as of April 20th for a total of $33 million. And most of this is from the recent grant acceptance and appropriation ordinance. So these 3 pieces together make up the revised budget of $9.3 billion, which is 25% higher than the adopted budget. And you can find additional detail in the memo, and this information is shown at the department level in attachment 1 to the memo. So with that more general budget adjustment background and context, the next couple of slides will focus on the bills that are before you this morning. Council Bill 120573, the carry forward legislation, requests approval for a total 2023 budget increase of $154 million from several city funds. And summary attachments submitted by the executive with the legislation show the details of all the items, and central staff has reviewed that list to ensure they meet the nature of a carry forward, which essentially is continuing work that began in 2022 and is anticipated to continue into 2023. So it just needs the resources to do so. And so what I've done here is highlight some of the big ticket items and items that may be of interest to council. And I can go through these, or I can skip over these, but they are covered on starting on page 5 of the memo. And all of them are detailed there as well in the summary attachment. So would you guys like me to just skip over or go through each of these?
I think you can skip it. The summary on the slides is good. And if others have questions at the end, we can come back to those.
Thanks, Chair Mosqueda. I would just note here to a question Councilmember Nelson asked in the previous presentation. You can see here about, 76-ish million of the Jumpstart carry forward is captured in the Office of Planning and Community Development and Office of Housing. So just flagging that as a follow-up to that question from earlier in the day.
Thank you.
Similarly, I'll do the same thing for the exceptions. The exceptions, Council Bill 120572, which is the 2022 exceptions. The total requested increase of $4.9 million is actually the lowest in recent 5-year history and longer. The average was up 18 million, so significantly lower. And there are 2 notable items. One is in FAS, and the other one is in SDOT for higher than budgeted overhead labor costs for the parking enforcement officers at SDOT. And this is a one-time exception request as parking enforcement officers were transferred back to Seattle Police Department in the 2023-2024 budget. Next slide, please. And so in closing, I'd just like to provide a reminder of the known upcoming budget adjustment legislation, which includes the soon to be transmitted mid-year supplemental and mid-year grant acceptance and appropriation. We'll also likely have a year-end grant acceptance appropriation as well as the year-end supplemental, which gets transmitted with the budget in the fall. And this is in addition to any standalone budget adjustments that occur throughout the year. In closing, if the council votes to make a recommendation on these two council bills today, they will be considered at the city council meeting next week on May 23rd.
Thank you so much, Ed. Thanks for your patience today too, as we got through two meaty presentations. Any additional questions for central staff? Seeing none, I'm going to go ahead and move these items here. I move the committee recommends passage of Council Bill 120574. Is there a second? Thank you so much. It's been moved and seconded that the exceptions bill for 2022, which requests approval for the 2022 budget increase intended to resolve instances where department overspent, is included in the 2022 revised budget allocations. Are there any additional comments? Hearing none, Madam Clerk, will you please call the roll and note that Councilmember Lewis and Councilmember Nelson are excused.
Yes.
Yes.
Excused. Aye. Thank you so much. The motion carries, and the recommendation that the bill pass will be sent to the May 23rd full council meeting for a final vote. There is another item in front of us that's Council Bill 120573, which is the 2022 carry forward bill. I move that the committee recommend that the passage of Council Bill 120573. Is there a second? It's been moved and seconded. Is there any additional comments? Hearing none, Madam Clerk, will you please call the roll on the passage of the bill?
Yes.
Yes.
Aye. Thank you so much. The motion carries, and the committee recommendation that the bill pass will be sent to the May 23rd City Council meeting for a final vote. Thanks again to Central staff for all of your presentations and your work today. If there's nothing else for the good of the order, our next Finance and Housing Committee meeting will be, when I am 1 year older, on July 5th, the day after my birthday. We will reconvene at 9:30 in the morning. Until then, please continue to join us at the Select Housing Levy Committee meeting, which will be held in 2 weeks on May 31st at 9:30 in the morning. We will have a briefing and discussion on the chair's proposed introduction of the mayor's housing levy renewal legislation. And then we'll have a public hearing that evening at 4:30 p.m. Invite members of the public to dial in or to come in person. Thanks, colleagues, for your time today, your generous time today. And with that, our meeting is adjourned. Thank you all.